Title: Debt in Business: Meaning, Importance, and Foundational Principles, Part 1. Definition of debt in business. Debt in business is an obligation arising when an entity borrows resources with a contractual promise to repay those resources, usually with compensation in the form of interest or other charges. It encompasses short-term and long-term borrowings, trade credit, bonds, loans, overdrafts, and similar instruments. Debt creates a claim on future cash flows and shifts risk between lenders and the borrowing enterprise. Significance of debt. Debt plays a central role in corporate finance. It enables firms to invest sooner than their retained earnings would allow, smooth working capital needs, and leverage returns on equity. Properly structured debt can lower the overall cost of capital, provide tax advantages where interest is tax-deductible, and discipline management by imposing repayment obligations. Conversely, excessive or poorly timed debt can strain liquidity, increase bankruptcy risk, and limit strategic flexibility. Principles of responsible debt management. Principle 1. Align debt with productive use. Explanation. Borrow only for activities that generate returns above the effective cost of debt. When debt finances productive investments, the enterprise converts borrowed funds into income streams that cover interest and principal while creating lasting value. Debt taken for consumption or speculative, non-productive uses erodes capital and heightens default risk. Analogy. Borrowing for business growth is like taking a seed loan to plant a tree that will bear fruit. Borrowing for a feast consumes the loan without future harvest. Common mistakes companies make. Borrowing to cover recurring operating shortfalls. Using debt to finance untested ventures without pilot results. Over-leveraging for acquisitions without integration plans. Company examples. An investment bank that operated with very high leverage and collapsed when markets froze. A retailer that lacked cash reserves and could not pay suppliers during a seasonal slump. A mid-cap firm that saw its credit lines withdrawn when covenants tightened. Lessons learned. Set conservative leverage targets tied to business cyclicality. Stress test cash flows under adverse scenarios. Maintain committed borrowing facilities and cash reserves. Principle 2. Maintain prudent leverage and liquidity buffers. Explanation. Preserve a balance between borrowed capital and equity to keep solvency and preserve borrowing capacity. Equally important is holding sufficient short-term liquidity or committed credit lines to meet obligations through cyclical downturns or unforeseen shocks. Prudence in leverage improves creditworthiness and strategic optionality. Analogy. A household keeps a reasonable mortgage relative to its income and a rainy day fund for job loss rather than living paycheck to paycheck with maximum mortgage. Common mistakes companies make. Stretching leverage ratios to chase higher shareholder returns. Neglecting working capital volatility and running low on cash. Failing to secure contingency credit lines before a downturn. Company examples. An investment bank that operated with very high leverage and collapsed when markets froze. A retailer that lacked cash reserves and could not pay suppliers during a seasonal slump. A mid-cap firm that saw its credit lines withdrawn when covenants tightened. Lessons learned. Set conservative leverage targets tied to business cyclicality. Stress test cash flows under adverse scenarios. Maintain committed borrowing facilities and cash reserves. Principle 3. Structure debt to match cash flow timing. Explanation. Design debt instruments so that repayment schedules and covenants align with the timing and predictability of the borrower's cash flows. Long gestation projects benefit from long-term finance. Seasonal businesses benefit from revolving facilities. Mismatched maturities create refinancing risk and pressure when revenue timing does not coincide with payment obligations. Analogy. It is like renting a delivery van for harvest week when crops are ready, not committing to a long lease when income is seasonal. Common mistakes companies make. Funding long-term infrastructure with short-term borrowings. Taking fixed amortization schedules that peak before expected revenue ramps. Ignoring covenant triggers tied to temporary drops in working capital. Company examples: an investment bank that operated with very high leverage and collapsed when markets froze. A retailer that lacked cash reserves and could not pay suppliers during a seasonal slump. A mid-cap firm that saw its credit lines withdrawn when covenants tightened. Lessons learned: set conservative leverage targets tied to business cyclicality. Stress test cash flows under adverse scenarios. Maintain committed borrowing facilities and cash reserves. End of Part 1. Continuing principles, additional mistakes, company illustrations, and comprehensive lessons to follow in subsequent parts.
Part 2. Debt in business: meaning, importance, and foundational principles. Principle 4. Preserve transparency and accurate disclosure. Maintain clear, timely reporting of debt levels, terms, covenants, and contingent liabilities so stakeholders and lenders can assess risk. Transparency reduces information asymmetry, lowers cost of borrowing, and prevents sudden loss of confidence that can trigger credit withdrawal. Analogy: honest bookkeeping is like a clear map for a shared journey. Without it, travelers get lost and argue over directions. Common mistakes companies make: hiding off-balance sheet obligations or complex guarantees, late or incomplete disclosure of covenant breaches, providing optimistic forecasts without transparent assumptions. Company examples: a mid-sized exporter that failed to disclose large supplier guarantees and faced lender surprise. A family-owned business that delayed reporting a covenant breach until renewal time. A venture that presented overly rosy cash projections to secure cheap short-term financing. Lessons learned: adopt conservative disclosure policies, document assumptions and scenario analyses, communicate proactively with creditors when performance deviates from plans. Principle 5. Manage currency and interest rate exposures. Control risks arising from mismatches between revenue currencies and debt currencies, and between floating rate debt and fixed cash inflows. Use natural hedges, diversification of funding sources, or financial instruments to reduce volatility in debt servicing costs. Analogy: it is like anchoring a boat in changing tides. Without proper anchors, you drift when currents change. Common mistakes companies make: borrowing abroad without hedging local currency revenue, using excessive variable rate debt when margins are thin, relying on short-dated forwards that leave long exposures uncovered. Company examples: an import-dependent trader that borrowed in foreign currency and suffered when the local currency depreciated. A service firm that took variable rate loans during a low-rate cycle and was hit hard as rates rose. An exporter that lacked hedging policy and saw earnings swing wildly. Lessons learned: align debt currency with cash flow currency where possible, set limits on variable rate exposure, institute simple hedging rules and review them periodically. Principle 7. Use debt to optimize capital structure, not to mask poor performance. Debt should improve weighted average cost of capital and support value-creating activities. It should not be used to mask operational weaknesses, fund unsustainable dividends, or temporarily prop up earnings. Sound governance separates financing strategy from avoidance of necessary operational fixes. Analogy: using debt as a plaster on a deep wound might hide the problem but will not heal it. Common mistakes companies make: issuing debt to pay recurring dividends or share buybacks while margins decline, rolling over maturing loans to postpone addressing structural issues, leveraging to meet short-term market expectations rather than long-term strategy. Company examples: a firm that increased leverage to sustain a payout policy amid falling sales, a business that repeatedly refinanced to delay restructuring, a management team that used cheap debt to mask creeping inefficiencies. Lessons learned: align capital decisions with sustainable cash flow prospects, prioritize operational turnaround before aggressive leveraging, set dividend policies tied to cash generation, not accounting earnings. Principle 8. Plan for orderly restructuring well before distress.
If stress appears likely, prepare contingency plans, engage stakeholders early, and evaluate restructuring options, debt reprofiling, covenant waivers, asset sales, equity infusions. Early, honest management of distress preserves value and avoids precipitous insolvency outcomes. Analogy: addressing a highline crack early prevents the entire dam from failing. Common mistakes companies make: waiting until default is imminent before engaging lenders, relying solely on emergency short-term credit, failing to prepare realistic restructuring scenarios and communication plans. Company examples: a manufacturing group that delayed negotiations and lost bargaining power, a seasonal business that sought emergency bridging loans at punitive rates, a company that scrambled for ad hoc solutions without a credible turnaround plan. Lessons learned: develop trigger-based contingency playbooks, maintain scenario modeling and stakeholder engagement channels, seek independent advisors early to preserve options. Closing of Part 2. Part 2 continued the principles of responsible debt management by focusing on transparency, risk management, covenant design, prudent use of leverage, and preemptive restructuring planning. Part 3 will present further thematic guidance, outline common cross-cutting mistakes across firms, give illustrative case vignettes, and summarize actionable lessons for management and policymakers.
Part 3. Title: Debt in Business: Meaning, Importance, and Foundational Principles. Cross-cutting guidance for executives and boards. Executives and boards should treat debt as a strategic instrument rather than merely a financing convenience. Regular scenario planning, integrated budgeting, and board review of debt strategy ensure alignment with long-term goals. Governance must require clear delegation for borrowing decisions, documented approval thresholds, and periodic review of covenant compliance. Transparent reporting to stakeholders builds trust and lowers the cost of capital. 3 pervasive mistakes firms make with debt. One frequent error is treating short-term liquidity gaps with long-term structural borrowing, which creates maturity mismatches and chronic refinancing risk. Another is relying excessively on optimistic forecasts to justify higher leverage, leaving firms exposed when reality underperforms models. A third is underinvesting in simple risk management: no hedging policy, no contingency credit lines, and no formal covenant stress tests. Illustrative corporate vignettes. A consumer goods company borrowed heavily to finance rapid expansion into new regions based on optimistic sales projections. When demand lagged, the firm faced rolling refinancing, credit downgrades, and an eventual rights issue that diluted existing shareholders. A small manufacturer used overdrafts and short-term loans to cover persistent working capital shortfalls instead of addressing receivables and inventory inefficiencies. The cumulative cost of repeated rollovers eroded margins and forced a restructuring. A service firm accepted a low-interest, covenant-heavy loan to fund dividends during a cyclical slowdown. When covenants tightened the following quarter, management spent months negotiating waivers at material cost and lost strategic momentum. Lessons learned for management practice. First, match funding tenor to asset life and cash flow rhythm. Avoid funding long gestation assets with short-dated credit. Second, require downside scenarios and sensitivity analysis before any material borrowing decision. Use conservative assumptions for pricing and volume. Third, maintain committed liquidity buffers and simple hedges to smooth volatility. Fourth, negotiate covenants that protect both lender and borrower and stress test them regularly. Fifth, use debt to enable sustainable value creation and not to conceal weak operations. Policy and market recommendations for regulators and lenders. Regulators and lenders can promote stability by encouraging prudent disclosure of contingent liabilities and by supporting standardized stress testing practices. Lenders should price transparent covenant flexibility and incentivize restructuring dialogues at early signs of stress.
Public policy can strengthen market resilience by facilitating access to affordable long-term finance for infrastructure and seasonal working capital, and by supporting financial literacy programs for small and medium enterprises. Practical checklist for corporate readiness. Boards should ensure the company has a documented debt policy, regular liquidity stress tests, a formal hedging framework, and an escalation protocol for covenant breaches. Management should keep an up-to-date schedule of all maturities, maintain a prioritized list of potential asset disposals, and preserve open communication channels with key creditors. Closing summary. Debt is a powerful accelerant when used with discipline, foresight, and transparency. The principles outlined earlier, coupled with the practical lessons here, aim to reduce the likelihood of crisis and to preserve strategic optionality. Firms that respect the rhythm of cash flows, anticipate adverse scenarios, and engage creditors early will convert borrowed capital into durable growth rather than mounting obligation.